Welcome to Forkast IQ. As the world accelerates into the digital economy, we're going to help you stay ahead with the latest in Web3, crypto, and data. It's where we look beyond just the headlines to get you the insights and knowledge that will help power smarter decisions. I'm Forkast's Megha Chaddah. All's well that ends well, and in this case, we are talking about Binance. The world's largest crypto exchange resumed withdrawals of Bitcoin around Monday noon in Hong Kong after temporarily halting the service twice within 12 hours due to what Binance said was a large volume of pending transactions. The outage on Binance came amid an unexpected surge in Bitcoin transaction fee, which led to transactions piling up on the world's oldest blockchain. Binance said it was attempting to resolve the issue by replacing pending transactions with a higher fee so that they get picked up by mining pools. The exchange also said it was working to integrate Bitcoin Lightning Network into its transaction services, which could help avoid such situations in the future. Now, data from CryptoQuant showed that the exchange saw an outflow of 188,000 Bitcoin on Sunday alone, the largest daily volume on its records to date. It turns out that the large transaction volume was driven by Bitcoin miners, as for the first time since 2007, some are getting paid more to process transactions on the blockchain than they are rewarded for creating new Bitcoin. On Monday, mining pools Luxor Technologies and Antpool got paid higher transaction fees from newly added blocks than the 6.25 BTC mining reward. Now, what's driving this shift? According to Glassnode, Bitcoin is experiencing extremely high demand for block space, partly due to popularity of BRC tokens. And what are these exactly? They are fungible tokens which use ordinal inscriptions to create and manage smart contracts on the Bitcoin blockchain. More than 14,300 BRC tokens have been issued so far since the standard was launched, compared to an estimated 400 million tokens on Ethereum. But keep in mind that this is just the start. And what a start it's been. Earlier this week, total market cap of BRC tokens hit $1 billion, but it has since cooled down to about half of that level by Friday morning in Asia. From smart contracts to exchanges then. On Tuesday, crypto exchange Bittrex US filed for Chapter 11 bankruptcy. According to its bankruptcy filing, Bittrex US had over 100,000 creditors with estimated assets and liabilities between $500 million to $1 billion. In a statement, the US exchange said the decision doesn't affect Bittrex Global, which will continue to operate for customers outside the country. On March 31st, the exchange had announced it would shutter US operations and had given customers up until April 30th to withdraw their funds. It added that customer funds that weren't withdrawn by the end of April remain secure, and the bankruptcy court will decide on the procedure for the distribution of remaining funds. Last month, the US Securities and Exchange Commission charged Bittrex US and co-founder Bill Stihara with operating an unregistered securities exchange in the country. The exchange rejected the charges. In February, the US exchange laid off almost 100 employees, citing the market downturn triggered by multiple crypto failures. In other news, a step forward for cryptocurrencies in the most unlikely place, China. Well, the Supreme People's Court of China declared virtual assets can be legally used to settle basic debts in cases involving transactions such as exchange and labor. Now, that's despite the country's ban on cryptocurrency transactions. The Supreme Court said in a January conference that cryptocurrencies share some attributes of virtual properties. It said that if the cryptocurrency transaction cannot be executed due to policy restrictions, the court will determine the compensation based on the actual value of the agreed amount of cryptocurrencies when the contract was signed. The Supreme Court added that courts won't accept any complaints from users if crypto was traded after September 4th, 2019, which was the date when the Chinese government issued a ban on initial coin offerings and crypto exchange services in the country. So how have crypto markets digested all these developments through the week? Not too kindly if the data is anything to go by, so let's bring in Jeff Chung to break it down for us. Jeff, how are crypto markets faring right now? Who have been the big movers and shakers?
Hey, thanks, Megha. Things have been moving pretty rough for the crypto markets in the past week. In case you missed it, two pretty big crypto market movers announced they were scaling back trading operations. Jane Street Group and Jump Crypto both announced these changes yesterday, both citing a tougher regulatory environment. But the market's only really taken the brunt of the impact today. The more popular cryptocurrencies, we're talking Bitcoin, Ethereum, and Solana, have taken some major hits over the last 24 hours. Bitcoin now down 3.19%. Ethereum's taken a slightly bigger hit so far, losing 3.42% in the last 24 hours, and Solana at 4.9% for the day. Now, in terms of weekly performances, well, things have been even gnarlier. Almost every single one of the top 20 cryptocurrencies have suffered losses in the last 7 days. Now, Bitcoin has dropped nearly 6.5%, and Ethereum has lost almost 4.3%. But amongst the currencies that suffered the biggest losses are Polygon, losing a jaw-dropping 14.25%, Avalanche with a whopping 11.39%, and Litecoin losing more than 8.5% in the last 7 days. It'll be really interesting to see how the markets continue to develop into next week, Megha.
Jeff, thanks for that. Meanwhile, the Middle East continues to be a hotbed of crypto activity. Dubai's Virtual Asset Regulatory Authority, or VARA, has given crypto exchange MasKex the initial go-ahead to start preparations for its launch in the UAE. Ben Caslin, Chief Strategy Officer of MasKex, joins in for more. Ben, glad to have you with us on the show. So some pretty exciting news for you guys, but can you tell us a little bit more about VARA and their approach to the regulation of digital assets?
VARA is unique because it is the first regulator that's specifically tasked with looking at and overseeing all virtual asset activities across, I think, 7 services and activities. It's quite exciting, and the VARA is definitely an institution that we like working together with. The regulator is not the enemy. The regulator is really someone to work together with to push the industry forward, and with it, to push the economy forward. It's going to be the first publicly disclosed headquarters by a crypto exchange.
So what has it been like setting up shop in Dubai? It seems like things have been going quite smoothly over there.
The UAE is definitely a place that is very friendly to entrepreneurs and to set up your entity and set up your company. And of course, they want to attract foreign investment and foreign talent. So, that's very good. A great place, and still there are many rules to abide by. So it really depends on how you run your operations.
Ben, let's also talk about the markets as well. The Bitcoin network's congestion over the past week has led to some dips in Bitcoin performance. What's your take on the current trends that we're seeing in Bitcoin?
The Bitcoin network is congested, and it's because of the whole BRC20 mania. So let's really look at it properly. First of all, Bitcoin has always shown to be extremely resilient. This is not the first crisis that has come to Bitcoin. Secondly, the miners are not complaining. They're earning a lot. And maybe that's good. The miners have struggled, the miners have suffered. It's fine for the miners to earn a little bit and get out of the. I think it's pretty okay.
And Ben, one last question: which direction do you see the markets taking in the long term?
So I think the coming 12 to 18 months might be the most interesting time in the digital asset space, only because we're really starting to hit the mainstream. Bitcoin is absolutely important for the coming 50, if not longer years, or more years. And at the same time, a lot of things can die. Like, yes, we're not going to live in a world with 1 million cryptocurrencies. So, as Do Kwon famously said, 95% of all cryptocurrencies will probably die. And it's true. Like, that's not he was very right, and he proved it to us as well. It's true.
All right, Ben, that's all the questions for you. Thanks so much for your time and insights. Well, time then for a quick break, but we will check in on the NFT markets when we return.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. We go to where the action is, from Asia to the world. Forkast is the most reliable source of intellectual discourse and insight that informs, educates, and bridges the gap between the blockchain industry and the mainstream. The future is being built, and Forkast has it covered. This is Forkast.News.
Thanks for staying on with Forkast IQ. The PEPE craze continues this week as the Memecoin found another home in crypto exchange Gemini. On Tuesday, Gemini announced the listing of Ethereum-based token offering trading and custody for the Memecoin. Gemini's move follows several top crypto exchanges including Binance, OKX, and Huobi. In the last month, the Memecoin's price has skyrocketed over 3,000%, that's 30 times, until earlier in the week, PEPE was clocking in billions of dollars in daily trading volumes. But as of Friday morning in Hong Kong, PEPE has fallen off the cliff, down about 27% in the last 24 hours. Now, earlier in the show, we spoke about BRC tokens built on the Bitcoin blockchain. And meme coins have taken over this one as well. Do you know what's the second biggest BRC20 token? None other than PEPE. But the BRC20 PEPE token is different from PEPE on the Ethereum chain, with the latter priced at a fraction of the BRC20 PEPE. However, its overall market value is way higher. Never a dull moment is there in the world of tokenized assets. So let's get in Jeff once again to tell us about the stories Forkast NFT indexes are telling us.
Yeah, well, Megha, in line with the broader crypto market, it has not been a good week for the NFT market. Sales in the Ethereum blockchain have seen slight increases in the last week, but that hasn't done much to remedy the losses of last week. High gas fees across the board aren't helping the situation either. Now, all 5 of the Forkast indexes are showing red over the last 7 days. The Forkast 500 index is down by more than 7% over the last week, but 2 of the other indexes managed to beat that figure. The Polygon composite is showing losses of 7.4% in the week, while the Solana composite is registering a dip of nearly 8.9%. A lot of these losses can be linked to the new meme coins coming out and taking a lot of the attention away from NFTs. Back to you, Megha.
Thanks, Jeff. Now, Forkast Labs NFT Strategist Yehudah Petscher also joins in to talk about the big moves in the NFT markets. Yehudah, good to see you.
Yep, thanks for having me. I love being here, so I'm enjoying another conversation with you.
Now, the meme coin hype is not going anywhere, and that's causing a surge in gas fee, Yehudah. How does it affect NFT markets?
Right, the impact of high gas is exactly what you see on the Forkast 500 index. We're continuing to just trend down, and we've been trending that way not just for days, not just for weeks, but it feels like we're heading that way now for going on 1, 2, 3 months. The gas is very impactful, specifically since meme coin season started again.
Let's talk about wash trading. Ethereum has over $365 million in NFT wash trade in April. What's going on?
Starting with the truths about wash trading, there are different truths depending on your perspective. Some who feel that wash trading is illegal, going by the SEC's definition, or their guidance, I would say, they have said that regulations are already in place. You have to look at the security markets and what their rules, regulations are there applies to NFTs. Some people consider these purely collectibles, and so transacting them for whatever motive, they don't look like they're making moves into positions that then are affecting markets. As we're filtering out wash trades and you're seeing this tremendous volume, like you mentioned, $635 million in wash trades in a single month, it's significant, and that does muddy the waters. On certain days, it's more than 50, 60, 70% of the sales are wash trades. It's a significant number. At its peak, I believe this was in February, we had a day where over 85% of all trades were wash trades. So it's a lot. It's good to filter that out.
And how would you say Blur is set up to promote wash trading?
It is a risky game, but that's essentially the game that is happening over there on Blur. It's incentivizing both sides of a purchase. So they're giving these incentives. At its peak was worth it was over $1. It might have been worth $1.50. And at the rate collectors, traders are earning them, it can be worth millions of dollars. So the top farmers were actually earning a few $1 million when we had the first Blur token airdrop. This was back on, I think it was Valentine's Day, like February 14th. So we had a huge distribution of Blur tokens. People were really excited, making a lot of money that in theory, they usually pump right back into NFT markets. So we usually see a bit of an NFT run after these kind of token infusions. And that's continuing now because it is now season 2 of Blur token farming.
Now, congestion on the Bitcoin network is due to the hype around BRC20 tokens. Binance, in fact, had to halt Bitcoin withdrawals twice this week. What's happening?
The Binance marketplace is now going to be listing those Bitcoin ordinals. So it's a large number, a growing user base that's going to be able to purchase these. But them coming to Binance is a big deal. And there's a little war brewing where Bitcoin developers now are looking for ways to filter out Bitcoin NFTs because they feel that it's breaking their ecosystem. Like we see on Ethereum with gas prices increasing, and it makes it much harder to transact. So like we have meme coins on Ethereum, we now have meme coins on Bitcoin, and that's new and it's disruptive.
And CryptoSlam welcomed a new blockchain to its collection rankings. Mythos, tell us about gaming assets and the use of NFT technology in gaming.
The microtransaction industry, that side of games, $76 billion is expected to be spent on game assets this year alone. It's doing about $1 to $2 million in secondary sales. It's a lot of money, nothing compared to the $76 billion we're going to see. So people are going to start funneling more and more into the blockchain and these NFT, game assets, and we're going to see products like DMarket just staying at the top of the leaderboard, climbing the leaderboard, tons more coming in. I just think that video game assets as NFTs are the future.
Yehudah, always a pleasure to have you on the show. All right, on that note, let's take a quick break. On the other side, we'll be turning our focus on Europe and how MiCA is pushing forward the crypto story there.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. The future is being built, and Forkast has it covered. This is Forkast.News.
Welcome back to Forkast IQ. Now, artificial intelligence technology, better known as AI, is all the rage at the moment. From using ChatGPT to develop venture funding pitches to creating a go-to-market plan. The possibilities are endless, but so are the pitfalls. Concerns over data security and potential for misinformation is gathering steam, even as governments urge responsible innovation. Last week, US Vice President Kamala Harris met executives from Google, Microsoft, and OpenAI to emphasize the need for ethical AI technology. While the UK has launched a review of benefits and risks of artificial intelligence. And you know who else is not entirely happy with the way AI is progressing? The Oracle of Omaha, Warren Buffett, who likened AI to atom bomb at the Berkshire Hathaway annual meeting earlier this week.
There won't be anything in AI that replaces a gene. I'll state that unqualifiedly. It can do amazing things, but things like checking all the legal opinions, since the beginning of time and everything, and eliminating all the it can do all kinds of things. And when something can do all kinds of things, I get a little bit worried, because I know we won't be able to uninvent it. And we did invent, for very, very good reason, the atom bomb in World War II, and it was enormously important that we did so. But is it good for the next 200 years of the world that the ability to do so has been unleashed? We didn't have a choice.
Meanwhile, sentiment in the crypto and blockchain world continues to cool. Over $54 million worth of investments exited digital asset products last week, according to CoinShares data. Though investments may fluctuate in the short term and crypto chill shows no signs of ending, those who are building the systems and protocols of tomorrow, they're hunkering down and continuing to build. Forkast Editor-in-Chief Angie sat down with some of the biggest protocol developers in the Web3 world at Consensus 2023 to find out how they're navigating these times.
What is the biggest challenge that collectively the industry is facing and what you're observing at Polkadot?
So I think the largest challenge there is actually often not the reality of the situation, but how the situation is perceived with respect to, do people want to come build it out in blockchain, or do they want to build in other spaces that have more hype? People follow the crowd, and I think the sentiment aspect is quite difficult for the bear market.
This is the first time I've ever seen that our industry was brought into what some people consider to be a bear market by the macro economy. So this bear market is actually not driven by deflation of interest in crypto. It's driven by a global macro slowdown, of which there are many factors.
Has strategy changed for you, Eamon?
Not really. So we are children of bear markets. We were born in a bear market, and what we do always is to build. And overall, I see bear markets as times of clarity.
The narratives in crypto generally has been around kind of next infrastructure, next technology, next kind of thing that somebody will build. And I actually think for the first time, we do have the technology, we do have infrastructure, we do have developers, and it's time to move away from just that to actually bringing users, bringing brands, building businesses, and really doing things that we promise when we talk about use cases, but actually delivering on those.
And talking about building those real-world use cases, one of the most popular ones is that of gaming. And we sure have come a long way from the days of playing Tetris on an old-school Game Boy. So how is Web3 changing the economics of gaming? Find out in this conversation between CryptoSlam's Johan Kalpu and John Linden, CEO of Mythical Games.
You guys have been in Web3. Why don't you go through like a brief history of Mythical Games and you know, what's the latest happening with you guys?
We saw free-to-play kind of moved our industry from 100 million gamers a month to nearly 4 billion gamers. And the second one, so we suddenly have massive amount of players that are playing in these worlds. And then the second one was really around content, right? We started seeing what we consider UGC, which is everything from esports, influencers, brands, musicians, celebrities getting involved in games. And we started seeing more content being produced than any one game studio could ever make on their own. So we kind of suddenly had this world of players and a world of stakeholders. And we really viewed Mythical as really kind of helping focus on the next generation of game.
You can catch the full conversation on CryptoSlam's YouTube channel. A reminder that CryptoSlam is a sister company of Forkast.News that is bringing you this show, and they are both under the Forkast Labs umbrella. 2023 is proving to be a defining year for crypto as policymakers worldwide shape up regulations for the digital assets. And Europe just sealed its lead in the token economy by greenlighting markets in crypto assets law, or MiCA. Forkast Jenny Ortiz takes a look at what this landmark law entails and means for the whole industry.
517 votes in favor, 38 against, and 18 abstentions was what it took to get markets in crypto assets or MiCA regulation approved on April 20, 2023. And with that, the European Union became the first major jurisdiction in the world to introduce a comprehensive crypto law. This milestone covers 27 countries with nearly 447 million people. MiCA was originally proposed in 2019, with the draft law informally agreed to in June 2022, but will only take effect 12 to 18 months after the legislation is published in the bloc's official journal. The regulation is meant to create a set of rules allowing registered crypto service providers to sell products across the EU. Transparency is an integral part of the law as it requires exchanges to inform users of the risks associated with their operations.
One of the main goals of MiCA is really to protect consumers. We have very, very clear laws on communication. So whenever a company wants to issue crypto assets, there is a very clear definition of what kind of information needs to be written.
Marina Markisic, president of the advocacy organization European Crypto Initiative, told Forkast, stablecoins and their regulation is integral to the new law. MiCA requires stablecoin issuers to hold sufficient reserves. How much money are we talking about? Well, stablecoins will have their daily transaction volume cap at 200 million euros or about $220 million. The law also requires stablecoins issuers to maintain a daily average reserve of 200 million euros.
I would say the very heart of this regulation is really the regulation on stablecoins, as we call them, e-money tokens or asset reference tokens. This rules around stablecoins are very, very, I would say, concrete and strict, especially when it comes to reserves. So stablecoins many times are used for payment purposes, and one of the other goals of MiCA, that is preserving financial stability in Europe, is also in a way manifested through those rules.
The law gives the European Securities and Markets Authority, or ESMA, the power to intervene and ban platforms that fail to protect investors or jeopardize market integrity. EU legislators also address the environmental concerns associated with crypto. MiCA requires businesses to disclose their energy consumption and the environmental impact of digital assets. The law also has a measure aiming to decrease anonymity in cryptocurrency transfers. Transfers exceeding 1,000 euros between exchanges and self-custody wallets will need to be reported. But there are important parts of the digital asset world that won't be covered by the new law: non-fungible tokens or NFTs, and the decentralized finance or DeFi. Leaders in the industry have welcomed MiCA.
We see it as a good thing. Is it perfect? No, nothing's perfect, right? Like, what it gives you though is certainty. It sets out very clear tests, very bright line distinctions, so that if you want to do things the right way, right, and Business Global does, but there are lots of people in the industry that want to do the right thing. This is how you do it.
The Europeans are very proactive. And if you look at their success in Web 2, I would argue it was fairly limited. Spotify is a good example. But now they're seeing the opportunity, and they're moving very quickly with MiCA. And I think we really commend them for, again, rather than look in the past, they're catering specific regulation and law to account for the uniqueness of this technology. And that's great.
With the EU sealing its lead in the crypto regulation race, Oliver Lynch has one reminder to the rest of the regulatory world.
The best and the most successful regulatory environments are the ones that engage with crypto as crypto.
Jenny Ortiz, Forkast.
Central bank digital currencies or CBDCs are the future of money, and digitizing the dollar is nothing less than a fight in the US, according to the former chairman of CFTC. His comments come in the light of the recent enforcement actions against crypto by the US SEC. Forkast editor-in-chief Angie sits down with Christopher Giancarlo, also known as Crypto Dad, to deep dive into these topics and a whole lot more in the latest episode of Word on the Block. Don't forget to tune in on Monday.
So we are a bit in the United States right now like deer caught in the headlights, at least in the official sector, because of this transformative, challenging new technologies. If you look at the revolution it potentially offers in payments, that's a threat to central bankers that have traditionally dominated and had a monopoly over payments, certainly in wholesale payments, in the banking system. If we view it as an opportunity to reset our financial system in a more democratic, open, financially inclusive, consistent with our constitutional principles of rights to privacy, an opportunity to reconsider the extraordinary scope of financial surveillance that is taking place already in the existing system, then I think this is a great opportunity. And I'd like to see the United States, rather than resisting it, be more open to it.
Well, that's a wrap on this week's show. Thanks for tuning in. Remember to like and subscribe to this video if you're watching us online, or stay tuned right here on this channel if you're watching us from home. It's easy to stay connected with Forkast for the latest developments in the world of Web3 and crypto. Great spending time with you today. It's how the future is shaping up. I'm your host, Megha Chaddah. Join us again same time next week as we bring you the latest from the world of Web3 and crypto. Forkast IQ, get intelligent in Web3.